I look at a typical business cycle, right? So if you were to overlay the S&P 500 with the 10-year, so right, if the 10-year is dropping, that means, you know, the long of the yield curve, or sorry, that means like bonds are going up, right? If the long of the yield curve is dropping. But if you look back at the last two business cycles, what we'll see here is, let's first look at 2007, right? You can see that the 10-year topped out in June, and in the short term, stocks got a little bit of a pop, right? So the 10-year topped out. That's where bonds bottomed. The S&P saw a short-term move to the upside. But the issue was that a few months later, the market realized why the 10-year was going down, right?
Mm.
And why the bond market was going back up. And it was because something was wrong with the economy. And then you can see that the 10-year continued to go down. And while in the short term, it was bullish for risk assets for, you know, a couple of months, it eventually resolved to the downside. Same thing the cycle before that, right? You can see that the 10-year topped out in January. The S&P continued to slowly go up, right, for another several months, not much higher than where it had already gone, but a little bit higher. But then eventually, as the 10-year continued to go down, then the market recognized, like, okay, this is why it's going down. It's because we're going into a recession. So I'm of the opinion that that is what's happening, right? You're getting your typical, you know, your typical rally after a pause, after bonds have potentially bottomed. I mean, they still could theoretically go lower. And again, these